Welcome to Close of Business. I'm Nadia Daly. Coming up on the program, long-awaited rate relief for millions of borrowers, but more rate cuts are far from certain.
Today's decision does not imply that further rate cuts along the lines suggested by the market are coming.
And a surprisingly hot jobs report, but why are some job seekers still out in the cold?
I have depleted all my savings. I borrowed money from family to keep me going. But at the end of this month, I have to ring the bank and say I can't afford my home.
Also on the program, an investment in the nation, why the federal and SA governments pledged a multi-billion-dollar bailout package for Whyalla's troubled steelworks. But first up, this week the Reserve Bank delivered its first rate cut in nearly 5 years. While borrowers digested the good news, the RBA governor admitted the central bank was late raising interest rates when inflation started to skyrocket in 2021. Rate relief's been a long time coming, but economists are warning the next cut won't be anytime soon. David Chow reports.
A quiet smile as the rate cut Dennis Graff's been waiting for is finally announced.
A little bit of relief. I think it's the first step towards some of the bills coming down. So yeah, mildly happy.
Money's been tight for this father of two with a baby on the way.
It's going to save us about $1,000 a year, just this first interest rate cut. So that's not insignificant as far as my budget goes. It'll go towards one of our annual holidays or some extra classes or something for the kids.
The Reserve Bank lowered the cash rate by 0.25 percentage point, down to 4.1%.
I think the board would allow me to say yes, it was consensus.
But further cuts aren't guaranteed, with the RBA governor saying the inflation fight isn't over.
What are the chances the Reserve Bank is one and done when it comes to interest rate cuts, and today's cut could be the only one that we see?
I couldn't say. What I would say is that the market is expecting quite a few more interest rate cuts till the middle of next year, about 3 more on top of this. Whether or not that eventuates is going to depend very much on the data. Our feeling at the moment is that that is far too confident.
I would call this one a hawkish cut, and what I mean by that is basically that the Reserve Bank didn't want to give the indication that it's going to cut rates aggressively from here because it doesn't want to stoke a secondary round of upside inflation, and it basically said that.
If lenders pass on the rate cut in full, homeowners with a $500,000 mortgage should see their repayments fall on average by $77 a month. And Australians with a $1 million mortgage should see their monthly repayments drop by $154.
It's a huge change for us. That's going to make a big difference.
Pretty good for a first home buyer, so yeah.
The big four banks moved within minutes, announcing they'll pass on the rate cut in full. But it'll still take about a couple of weeks before you notice the rates on your home loan come down. As a borrower, you have the choice of reducing your minimum monthly repayment or keeping them as they are in order to pay off the loan quicker. Either way, it'll cost you less.
We're seeing mortgage holders who are under enormous amounts of financial stress and who are really just hanging in by a thread. So this will be welcome.
With an election looming, politicians were quick to jump on the announcement.
This is the rate relief that Australians need and deserve. Now, we know that it won't fix every challenge we have in our economy or in household budgets, but it will help.
The journey is far from over. Australian families have done the hard work here, and they deserve this interest rate increase because they're the ones that have done the work.
Economists don't expect much more relief in the next few months.
Well, I'd be reasonably of the view that we won't get another cut ahead of the election.
Dennis is depending on more rate cuts to ease pressure on his family finances. But first, a bit of celebrating.
We've got a mate coming over tonight, so we might have a beer and talk about what we're going to do with our extra $1,000 a year that we've got each now.
Welcome rate relief for borrowers across the nation.
The latest wages data has reinforced some economists' view that the Reserve Bank made the right call to cut interest rates. Home borrowers have welcomed the cut, but are also questioning exactly when lenders will lower the cost of their loans. Rihanna Whitson reports.
After the excitement of the RBA's first rate cut in 4 years.
We were so happy listening to that.
Such a relief.
The question for home borrowers now is, when will their bank lower their variable rate?
We haven't celebrated that yet, but we will do something once we get that change in the repayment.
Some lenders like Athena have already passed the rate cut on, but 3 of the big 4 banks and Macquarie are holding out until the 28th. It's 4th of March for Westpac customers and the 10th for HSBC home borrowers.
We could see the lowest variable rate drop to around 5.5%.
So we won't see any change today.
This mortgage broker's clients need rate relief now.
They're still in pain and they're expecting for the rate to be passed on the same day or the next day.
While delaying rate cuts is good for bank profits, it's bad for borrowers.
They're losing money every day in interest payments, and it's making them falling behind, paying their home loans off as soon as possible.
Adding to the pain, wage growth has fallen to its lowest level in more than 2 years, slowing from 3.6% in the year to September to 3.2% in 12 months to December. That's in line with the RBA's forecasts. Australians are still getting a real pay rise though, with wages rising above inflation, thanks in part to rent and energy subsidies.
The wages numbers came in a little weaker than was expected, and that slowdown in wages growth is a critical part of continuing to see inflation track back towards the RBA's target.
The Federal Treasurer has asked landlords to consider the rate cut when setting their rents, and acknowledged Australians are still doing it tough.
Even with the progress that we've made together on inflation and wages and now interest rates, we know that people are still under pressure.
For many Australian families, this will be too little, too late.
While borrowers wait for lenders to pass on the Reserve Bank's rate cut, the RBA Governor has poured cold water on the prospect of the relief ramping up. However, Michelle Bullock's caution is also by design, to prevent spending sprees which could see inflation rise again.
We think that there's only one more interest rate cut coming this year, and we think that's likely to arrive in the 3rd quarter of this year, and we've got in mind that there might just be one more in the early part of next year as well.
High rates have meant fewer patrons for this Queensland publican.
I'm very confident this week we're going to see a lot of relief.
As for when her own bank will pass on the rate cut, Jade Moore is still waiting to hear.
Hopefully everyone will pass that on. We can see a bit of relief in the economy, which will benefit small business, benefit individuals, benefit families. The RBA, fingers crossed, will cut interest rates again.
Hope that may take a while to become reality.
A hot jobs report. That's how analysts described the January jobs numbers. The unemployment rate has ticked up to 4.1%, as expected, but the labour market remains surprisingly strong. And as Nassim Kadem reports, not everyone is finding it easy to get the right job.
Dilhara Sivalingam once had a successful career managing multi-million-dollar contracts for government agencies, but she hasn't had a permanent job since 2021 and has been out of paid work since October.
I'm actually following up on your phone call to me earlier yesterday afternoon.
The 49-year-old says the search for employment has become too controlled by AI, with the application process almost like online dating.
I feel like I'm playing the Tinder of recruitment. And I feel like when I submit an application and cross my fingers and look at my laptop, I feel like on the other side of that laptop, someone's going swipe left, swipe left, swipe left. Too expensive, too experienced, don't like her name. My absolute favourite is may the best days of your past be the worst days of your future.
She's applied for hundreds of jobs and is trying to refocus her efforts by writing positive messages daily. But the reality is bleak.
I have depleted all my savings. I borrowed money from family to keep me going. But at the end of this month, end of February, I have to ring the bank and say I can't afford my home.
But there may be some hope. 44,000 jobs were added to the economy in January, all full-time roles, mainly filled by women. Female workers also made up the bulk of 23,400 people joining the jobless queue, with some waiting to start new roles. More people decided to look for or find work, pushing the participation rate to a record high. All this meant the unemployment rate ticked up to 4.1%.
As households have found themselves under greater financial pressure, more women have returned to work and more women are working full-time.
But the jobs market could get tougher.
It is reasonable to expect that in the months ahead, with the sort of uncertain global conditions, it's possible that we may see a further slight increase in unemployment.
A number of fashion brands have collapsed and more employers are axing staff. Westpac has just announced 190 job losses and thousands could go in Victoria's public sector in the coming weeks. But recruiters say the latest interest rate cut has provided a silver lining.
I think a lot of people have actually structured their lives in line with what the rates are now, so they'll free up a bit more cash, provide more confidence into the community and into the economy, and hopefully push businesses forward.
The strength of the labour market is probably the one thing that's holding the Reserve Bank from doing more in terms of cutting rates. Reasonably speaking, we can expect another 1 or 2 rate cuts this year, but we may well see more.
Dilhara's hoping she'll find a job soon, but says she rarely gets feedback from recruiters when she misses out.
For me, it's a numbers game to put an application in. For them, it's a numbers game to just recruit and meet their targets. So I find it really, the whole process really unfair, heartbreaking in a lot of instances.
It's a struggle more workers could face in what's lining up to be a more challenging jobs market.
Well, as we've heard, after 13 rate rises, millions of borrowers have been delivered some rate relief with this week's cut, which will reduce the average home loan by around $100 a month if it's fully passed on. Whilst it's not expected to spark another boom, analysts say it could arrest recent falls in the market. I spoke to PropTrack's senior economist, Eleanor Creagh. Eleanor Creagh, welcome to Close of Business.
Thanks for having me.
It's a relatively small rate cut, equal to about $25 a week for the average mortgage. So just how much of a difference will this cut make to property prices?
That's exactly right. So when you break it down and you look at how much the average household with a mortgage will actually save, it's not very much. Now, it could be a little bit higher if we look at a median house in Sydney, say. We could see that people with a mortgage are saving around $200 a month, so maybe a little bit more. Some of the more affordable markets, it's going to be a little bit less. But nonetheless, that one interest rate cut in isolation doesn't give that much back to the average household with a mortgage. But certainly I think where the effects will be felt is that sentiment boost. So it's not just the fact that we've had one interest rate cut, it's the fact of what this signals for the economy. So we've managed to bring inflation back down from almost 8%. We're at a point where potentially we're looking ahead towards further interest rate cuts, and we've reached that point where the Reserve Bank have managed to manoeuvre what's called a soft landing for the economy. So I think for households, the impact is really around that sentiment boost. And I think that that's where we're going to see the impact being felt in the housing market as well. So whilst we know that maximum borrowing capacities will increase slightly, so people will be able to borrow a little bit more with this interest rate cut, it is that sentiment uplift that's probably going to drive renewed confidence amongst potential home buyers and probably renewed price growth in the housing market as well.
In terms of property prices, we've seen a bit of a difference between different suburbs and different cities. Some of the wealthier suburbs have seen prices drop by around 20%. So will this rate cut put a bit of a floor under those falls, do you think?
I think that probably is the case. So the price falls that we've seen over the past couple of months, we're expecting that they are likely to reverse. So they'll end up being pretty short-lived, and probably this renewed sentiment boost is going to drive renewed home buying demand and home price growth. Although we do know that the affordability starting point that we're currently at is incredibly stretched. So affordability is at its worst point at any point in the past 3 decades. So that price uplift is likely to be a little bit more muted relative to previous easing cycles. And the price growth that we're likely to see throughout the remainder of the year is probably going to trail the pretty strong price growth that we've seen in recent years. Now, you talk to the dispersion of home price growth that we've seen over the past year across the country. And we certainly have seen that below the hood or below the national figures, we've had a real regional dispersion in home price growth, with smaller capital cities like Perth, Adelaide and Brisbane really continuing to outperform, Perth leading the charge, and then some of the other capital cities at the other end of the spectrum, Hobart and Melbourne, seeing prices fall over the past year. But I think the broad trend has been one of price growth slowing throughout 2024, with real challenged affordability conditions weighing on home buyers. Of course, the sustained higher interest rate environment last year, weaker economic conditions and the uplift in stock hitting the market throughout the spring selling season.
Now, the government's been urging landlords to pass this rate cut on to renters. Do you think that's likely to happen?
Now, when we look at the rental market, rental prices are typically driven by supply and demand. And we've seen that rental market conditions have been incredibly tight in recent years, really driven by very strong rental demand intersecting with incredibly tight supply. We have begun to see that conditions are easing in the rental markets. So most capital cities have seen an uplift in rental vacancy rates over the past year. We've seen that investor activity has been a bit stronger. That uplift in investor activity has helped to support a rise in rental listings. And at the same time, rental demand has also eased off a bit. So we know we've seen slowing student arrivals, slowing net migration, and probably also larger household sizes, as rental affordability has been incredibly poor and deteriorated so significantly. People have been forced back into share houses and living with more people. So that intersection of easing rental demand and increasing rental supply has been driving what we see as an increase in rental vacancy rates and easing conditions in the rental market. We're expecting that is going to continue, so that will work to slow the pace of rental price growth. However, the caveat is, although this is certainly good news for renters who've really had a very tough 4 years, the pace of rental price growth still remains historically strong, and where rents have risen to means that rental affordability is incredibly poor.
And briefly, I have to ask you the question everyone wants to know the answer to: how many more rate cuts do you think we'll see this year?
Now, the interest rate cut that we received this week was probably about as hawkish as you can get when we're looking at interest rate cuts. And certainly we've seen that all the messaging from the Reserve Bank has really been trying to push back against market pricing and push back against expectations. Now, we're expecting that we're probably going to see 1 or 2 more interest rate cuts by year's end.
Okay, so 1 or 2. Eleanor, Creagh, thank you very much for your time.
Thank you for having me.
It's been an unprecedented week for Australia's steel industry. The federal and South Australian governments will fund a $2.4 billion rescue package for the Whyalla steelworks, labelling it an investment in the nation. The jointly funded package will focus on paying off creditors, delivering plant upgrades and supporting a new owner when one is found.
A sense of relief for these workers in Whyalla.
It's a great day, seriously. Yep. I've been here 25 years and this is a good day.
The frustration and the uncertainty is what the killer is.
The announcement of a $2.4 billion federal and state support package greeted with applause as the Prime Minister offered a helping hand to South Australia.
This is the heart of this area in Whyalla. But the arteries spread out right around the country.
The steelworks, which employs 1,100 people directly, was taken over by billionaire businessman Sanjeev Gupta's GFG Alliance in 2017 after it had gone into administration. But 8 years later, with hundreds of millions of dollars owed to creditors, the business is once again back in administration, with $50 million of taxpayers' money set aside to pay its debts.
We're not supporting Mr Gupta. We're not bailing out Mr Gupta. His debts are his debts to be accounted for. No one's bailing him out. Far from it.
The opposition leader Peter Dutton supporting Labor's rescue package.
Well, we want to make sure that jobs are protected and that steelmaking continues because it's an essential industry for our country.
But the Prime Minister wouldn't be drawn on whether the funding relies on him holding government.
Well, we're going to win the next election.
BlueScope Steel, Australia's largest steel manufacturer, which is in talks with the administrators Corda Mentha in the mix to take over the crippled business.
And I am absolutely certain that there will be people coming forward wanting to take up this opportunity.
An opportunity to save the steelworks again.
A new report by the Productivity Commission paints a stark picture of the state of residential construction in Australia. It shows housing construction productivity has been going backwards for 30 years. The poor performance is blamed on a lack of innovation, too many small players and skill shortages. Commissioner Daniel Wood says the sector is badly lagging the rest of the economy.
So what we've seen is that housing construction productivity has been going backwards for 30 years. So if we look at the amount of house built per hour worked, that's down about 50% on where it was 3 decades ago. And when we adjust for the fact that houses now are bigger and better quality, productivity is still down 12%. And to give you a sense of how that compares, the rest of the economy has increased its productivity by about 50% during that period. So we are really going in the wrong direction. I think on the regulatory side, it involves really saying we're going to emphasise housing supply and affordability in every decision we make. We have a whole range of regulatory objectives that are in play in the housing sector. Many of them are very worthwhile, but the cumulative impact of those has been to increase the time and complexity of building. So I really think we need to look at it with a fresh eye and very much with a sense of needing to streamline what's there.
Investors cheered the rate cut this week, but the big banks and miners dragged on the markets. It was all downhill. The ASX 200 and the All Ordinaries ended the trading session down more than 3%. I spoke to independent analyst Evan Lucas to wrap up the week. Evan Lucas, welcome to Close of Business. Now, the big story of the week was the RBA rate cut. How close was the call to cut rates and when could we see the next one?
I actually think it was much closer than what's been given credit. Yes, we hear Michelle Bullock talk about the fact that they had a consensus, but overall, if you listen to what's coming from the statement, from her press release, but also from the statement of monetary policy, is that they are still clearly very, very concerned about inflation. I mean, they're forecasting that inflation on the headline figure will get to 3.7% by Christmas, that the trim mean, the core figure, will hold at 2.7% for 2.5 years, all things being equal. That's not including the fact that we've got a federal election coming up and the possibility of spending that that's going to bring. So it was much closer than I think some are realising. It also explains why, when she was pushed around further rate cuts and when they'll come, that she was basically saying the market is well ahead of itself. You need to understand that we are sort of in not only an uncertain period, but we're also staring down the barrel that rate cuts may actually not happen, not just for the foreseeable future, but at all. Now, I personally think that there will be probably a minimum of 1, maybe 2 more, but they are going to come in the last quarter of this year. They're going to probably wait till September to get 2 quarters of data, both from the GDP and also the inflation figure for this calendar year.
The share market ended the week lower. We also saw the share price of some of our major banks taking a hit.
So I think with the banks, they have been, trading at record all-time highs. We need to probably ring fence out CBA. It's showing you just how incredible of an operator it is. NAB's now sort of showing that it's also slightly falling back to the pack. They're all experiencing what you normally do experience in a period where you have, high interest rates, threat and pressure around the home loan scenario. We saw delinquency start to tick up at Westpac and NAB. Loan growth outlook has not been as rosy. With that in mind, you can't justify record all-time highs. It also probably points to the fact that the banks themselves now have a conundrum because their margins are starting to shrink at the same time. And what they do, there was that big question this week, do they or don't they pass through the full 25 basis points? It's not about this one, it's the ones in the future that I think that question will become poignant. The second part of your question around what's going on with miners, it's again also where we are in the cycle. You should see a decline in the demand for steel. Therefore, you will see a decline in iron ore. I mean, that BHP number was fascinating to see that coking coal and iron ore, obviously both involved and major ingredients in making steel, had fallen between 23 and 24% respectively on price, despite the fact that volumes were near enough to record highs. So it just filters into that whole other global perspective that we currently sit in, which is that things are slowing down and we can't sustain the high prices that we've had.
January jobs data was in line with expectations, but what's the significance of that for future RBA decisions on rates?
They were in line, but they were slightly to the upside. And I think what also we're forgetting is that, again, let's ring fence out employment. It's a really, really, positive figure to be looking at. It's not just what happened in January, but what's been happening over the last 14 months. I mean, we have never employed more people in this country than we have right now. We've never employed more females than we have right now. The level of participation is at or near enough to a record all-time high. And despite the unemployment rate ticking up to 4.1, that's because more people are actively looking for work because they're believing they're going to get it. The caveat to that is that we have never seen so many more dual income families. That I would actually argue is a positive. There's obviously a better uptake in both male and female work, but it does also put upward pressure on childcare. It's putting upward pressure on demand. Are they doing this because to get through the cost of living we currently have, both members of the household are having to work more or even work 2 full-time jobs rather than 2 part-times or a part-time jobs? That will be up for debate. And from an RBA perspective, it is putting upward pressure. It means that more money is coming to the household and therefore also more money is being spent in the household to push up that inflation rate. That's why they are slightly nervous, and what they're watching going forward is that the household is doing whatever it can to get through this period, even with a higher interest rate than they probably expected.
Evan Lucas, always a pleasure to speak with you.
Thanks for having me, Nadia.
And that's all from Close of Business. For more on those stories, go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern Daylight on the ABC News channel and after the late news on ABC TV. I'm Nadia Daly. Thanks for watching.